Yeah, I mean, the two biggest underperformers today are obviously, Ramsay and Link, both under takeover bid as of yesterday, but as of today, one uncertain and one definitely off the table. So it just goes to show that just because the company you own is being bid for doesn't mean that the M&A is going to actually follow through. And there's often a reasonably good probability that something gets in the way. So I think the fact that the Ramsay board didn't jump at KKR's bid, and then there was all these conditions on the bits that were partially owned, and it just became all too hard, I think. So Ramsay, directors now have to prove to the shareholders that, not going ahead with KKR's proposal was the right thing, because they've got about 20 or $25 a share to make up to back to that level. And with the Link, I mean, they're involved in some UK regulatory things. There was a fund manager called Woodford, who was a sort of gun income manager, went out on his own, got into some conduct unbecoming, as Prince Andrew would say, and got himself into a lot of trouble. And Link look like they're implicated in that. So Dye and Durham have got a bid on the table there. You'd have to say that they're going to have cause to pull that bid based on this regulatory issue. So that stock was obviously well propped up by takeover bids. But yeah, M&A goes away. You can't depend on it. And there are some bids in the market that the market's just assuming going ahead. BHP's bid for Oz Minerals, for example, the stock's trading above the bid price there. It was trading 25% below the bid price. So it's kind of one of those things that BHP might just go, look, we need to pay 30 or 35 to get this. We're not going to do that. We're pulling the bid altogether. Where does Oz Minerals go? So I'm not predicting the outcome. I'm just saying from a risk return perspective, if you own some Oz, maybe you just want to let some go, just on the probability or possibility, I should say, that BHP walk away.
I mean, is this company management misunderstanding perhaps the financial environment that we're in, that they expect that there will be another bid to basically match the price and that they can kind of encourage a higher valuation, or is there something else going on here that's, I guess, driving these dynamics a bit?
Yeah, I mean, it's always an interesting one because psychologically, directors always think their company's worth more than everybody else. Whenever you go and see a managing director, he always thinks his share price is undervalued. And quite often you get management teams at companies getting really upset with brokers because they don't put a high enough valuation on the stock. I've seen that happen a lot. So you got that in the back of your head, which always, pushes against the takeover bid. So buyers in this environment will be taking advantage of the fact we're in a global bear market. Global equities are down 25, 30% from their highs in some markets. So buyers are being opportunistic, but sellers are going, look, I really don't want to sell my house unless I absolutely have to. So that's the tension, but quite often you have directors probably should take a bid. It's a good bid for the shareholders, but the work is now on the directors. As I said with Ramsay, for example, they've got to make up $25 a share, which ain't easy, right?
No, that's a lot of value to create out of thin air. So let's just move on to the macro because we have US CPI tonight. Is this going to be a game changer? I know that we've basically got a 90+% chance of 75 baked in for the Fed next week.
Yeah.
What could come of this CPI figure tonight?
Look, I suppose there's been a massive amount of options positioning in the US on this, like a record amount of call options are purchased going into it, and there's already a record amount of put options on the other side. So it's one of those things that expectations are quite narrowly banded around. We're going to get 0 to slightly negative on the headline, and we'll probably get 0.3, 0.4 on the core. So that'll give us sort of 8.1 and 6.1. So core's going to be up a little bit, that headline's going to be down, and that's the 3 months in a row of negative, of lower inflation. So that whole peak inflation narrative is building. If it falls outside those, quite a narrow range, we could see a volatile night. We could see a 1 or 2% move on Wall Street. If it's on the downside, it'll be a rally. If it's on the upside, it means we're definitely getting 75. There's still a little bit of risk around the 75 from the next Fed meeting. So it could be a game changer for markets. I think the most important narrative is if it's clear that that inflation's peaked, then we should see a peak in rates. Now you can see the shift in the Fed futures pricing. Everyone's now front-loading rate rises. If you look at even at the end of July, we were looking at 3.25% cash rates in January. We now look at 4% in February. But more importantly, we get there a lot faster. So this is the aggressive do whatever it takes to kill inflation sort of scenario. So that's quite bearish for markets. So if that happens, equities are going to stay under pressure in all corners of the world. But if we get a weak inflation print, like worse than expected, that'll come rallying straight back in. So you can, that's why I think tonight's a really, really important number. I don't know if you've got Australia there as well, but Australia's shifted, but nowhere near as much as that.
Yeah, okay. I don't know if we do have Australia there. We can have a look and fiddle around with it in a sec. Just with that though, I mean, if we've got the federal funds rate at 4% next year, yeah, it's potentially in the price already. But with equities where they are at the moment, surely this is looking a little bit lofty for you at these levels on that assumption.
Yeah, I don't think 4 is baked in. I think equity analysts have still got positive earnings growth. I've seen a couple of global investment bank reports out in the last few days just saying, right, into the end of the year and into next year, what's it looking like? We've just had a whole bunch of fresh information from companies, so we're reasonably up to date with where we're trading, and we're still looking at 7 to 8% earnings growth in the US next year. A 4% cash rate is going to kill that. Their economy and their consumer is not as rate sensitive as we are here because it's mostly fixed rate debt. So I think the issue there is that I don't think a recession is priced into earnings. Earnings will, in a recession, have to be lower than, not higher. So I think there's a 10-15% earnings downgrade, and then what do PEs do in that uncertainty? US is on something like 17 times forward. We might actually see that come in. So you could see if that 4% comes about, I think the market will be lower, potentially quite a lot lower. So I'm thinking that that's the market. Most economists are nowhere near that. Maybe the Fed is, but a lot of professional economists are saying the Fed doesn't need to act that aggressively.
Yeah, right. Almost out of time, but I wanted to have one more topic of conversation that we did cover, which is lithium. And in fact, I had to write an article just for some financial writing over the weekend about lithium. And I thought, actually, if I'm writing this, maybe it's getting a little bit toppy here if it's being requested. But nevertheless, we are seeing a lot of strength coming through the space. Clearly, one of the maybe good, feel-good stories about the ASX going forward. We have a lot of lithium under our soil. What's happening there?
Yeah, I mean it's rocket fuel, right? So we kind of need this to power the future.
Yeah.
We need it for the batteries, and we've gone from a scenario of oversupply to massive undersupply, and everyone's scrambling to get the stuff. It's one of the few commodities that's actually trading above most estimates in the market, and we've got a bunch of listed Aussie listed lithium companies, and they add up to over $50 billion in value. So to put that in context, about 3% of the market, and it's about the size of Wesfarmers. So these group of stocks are becoming a really important part of the market. And for fund managers who don't own this, because I think it's a bit frothy, it's now quite a big risk not to own. So, we own Pilbara in our portfolios, and it's like without that this month, you're really struggling to keep up with the index. So, but it's one of those things you kind of go, I can just see demand for this growing. It's not like iron ore, where it really depends on what China's doing in construction, and it's really a cyclical sort of story. This is a structural story. We're going to continue to need this stuff for a while, and it's really, really hard to get out of the ground. There's lots of it around. It's one of the most abundant elements in the world, but it's really, really hard to bring to the market. So you kind of say, if you're already up and producing and you're getting these massive prices for your hydroxide, then, happy days. And so we're also going to get probably more consolidation in the industry because there's a lot of smaller players, but the big ones really control the market. So you've got independents, Allchem, Pilbara amongst the 100 that are really the big players. They're all $10 billion plus companies.
I was going to say on that too, I mean, with the way that our mining space often evolves and that sort of process of consolidation that can happen, I mean, is it kind of like a BHP or a Rio will be sort of keeping their eyes out to snap up one of these names to kind of create that synergy within their existing mining business if lithium becomes structurally important?
For them it's too small. I mean, BHP is almost a $200 billion company, so even Oz Minerals is arguably too small for them. So I think for them to get into lithium, it's a really niche player. Right. Even if they control 40 or 50% of the world's supply, it's going to be tiny. So for them, it's probably a no. It's really about amongst the mid-sized players. You've got Albemarle in the US, you've got SQM in Chile, and then you've got the big ones in Australia. I think between them, you might see some further consolidation amongst the big five.